What happens to your life's greatest investment when the global financial system decides your zip code is no longer worth the risk? For thousands of American homeowners this year, the answer arrives not as a natural disaster, but as a silent, 3-paragraph letter in the mail. It is a non-renewal notice, a cold, bureaucratic signal that the invisible safety net holding up your mortgage has just been cut. There was no smoke, no rising water, and no shattered glass. From the sidewalk, everything looks exactly the same. The oak trees are still tall, the roof is intact, and the neighborhood remains as quiet and stable as it was 30 years ago. But inside the servers of global reinsurance giants, your home has been fundamentally recalculated. You haven't changed, but the math has. A proprietary algorithm, processing 1 trillion data points of climate volatility and reconstruction costs, has quietly erased your property from the ledger of the insurable. This is the silent birth of a new economic class, the uninsurable. We are witnessing the beginning of the Great Withdrawal, a structural divorce where capital is abandoning the American middle class to face a volatile future alone. It is a shift that transforms the family home from a sanctuary into a stranded asset. To understand how we reached this tipping point, we must look at the hidden architecture of risk that governed the last century. For the better part of the last century, the American middle class operated under a silent contract with the financial industry. The terms were simple. If you worked hard, saved a down payment, and maintained your property, the system would guarantee its protection. Insurance was the invisible lubricant of this machine. It turned the terrifying volatility of nature into a predictable monthly expense. It was the only reason a bank would ever dream of lending you hundreds of thousands of dollars to buy a pile of wood and brick. In 1950, the math of risk was local and relatively stagnant. Actuaries looked at 100 years of weather patterns and saw a bell curve of predictability. A house in the suburbs of Illinois or a bungalow in coastal Florida carried a risk profile that was essentially set in stone. Because the risks were rare and isolated, capital was abundant and cheap. Insurance wasn't just a safety net, it was a subsidy for the American way of life, allowing cities to bloom in deserts and on floodplains. But by the mid-2020s, that bell curve has been shattered. The data that the industry relied on for decades has become obsolete. Between 1980 and 2023, the United States averaged about $8 billion weather disasters per year, adjusted for inflation. By 2025, that average has more than doubled. It isn't just the headline-grabbing hurricanes or the massive forest fires that are draining the vaults. It is the relentless, daily erosion caused by what the industry calls secondary perils. Severe convective storms, hail, and flash flooding in areas never marked on a FEMA map are now occurring with a frequency that defies traditional modeling. In 2023 alone, these secondary perils caused over $50 billion in insured losses across the United States. For the insurance companies, these aren't just statistics. They are a signal that the environment has moved faster than the infrastructure designed to withstand it. The math no longer pencils out for a 30-year commitment. The cost of fixing a home has also decoupled from the general rate of inflation. Between 2019 and 2026, the price of construction materials and specialized labor surged by nearly 40% in many regions. When a storm hits a neighborhood today, the payout required to rebuild according to modern codes is often higher than the original value of the home. Insurers find themselves in a trap where they are collecting premiums based on yesterday's value, but paying out claims based on tomorrow's costs. As a result, the national average for home insurance premiums has spiked by 20% in the last year alone. In states like Florida, Louisiana, and California, the increases are closer to 50 or 100%. But the price of the premium is actually the lesser problem. The real systemic shock is the exit. Major carriers like State Farm and Allstate have started a strategic retreat, ceasing to write new policies in entire jurisdictions, not because they are losing money today, but because they cannot see a path to profit tomorrow. This withdrawal is driven by a layer of the financial system that most homeowners never see: the reinsurance market. Reinsurers are the insurers of insurers, global giants like Munich Re and Swiss Re that provide the capital backbone for your local agent. These companies move their money around the globe with cold, mercenary efficiency. If they decide that a wildfire in Paradise, California, or a hailstorm in suburban Texas is no longer a once-in-a-lifetime event, they raise their rates on the primary insurers. When reinsurance rates go up, your local insurer has two choices: pass the staggering cost on to you or leave the state. Many are choosing to leave. When they do, they leave behind a protection gap, a vacuum where private capital used to be. In its place, state-run insurers of last resort are bloating to dangerous levels. These government-backed programs were designed to handle a few thousand high-risk properties, but they are now supporting millions of homes, often with inadequate reserves. By 2026, we are seeing a massive geographic repricing of reality. Areas that were once considered the bedrock of American stability are being reclassified as high-risk frontiers. The capital that built these neighborhoods is looking for the exit, and it isn't coming back. This is not a temporary market correction. It is a permanent realignment of where it is economically viable to live. And as the capital vanishes, it leaves behind the individuals who believed the promise of permanence was guaranteed. To understand the weight of these numbers, we have to look past the spreadsheets and into the living rooms of those who are currently standing at the edge of this financial cliff. Marcus and Elena represent the archetype of the American success story that the system was built to reward. He is a mechanical engineer. She is a healthcare administrator. In 2018, they purchased a 4-bedroom colonial in a quiet suburb of Raleigh, North Carolina. It wasn't a speculative gamble or a vacation home. It was their fortress, the vehicle for their children's inheritance, and the foundation of their own retirement. For 6 years, the house performed its economic duty. Its value climbed steadily on paper, creating a sense of wealth and security. But in the spring of 2026, the quiet rhythm of their financial life was punctured by a single letter from their longtime insurer. The company wasn't raising their rates, they were simply walking away. The notice stated that due to rebalanced risk concentrations, the company would no longer provide coverage for their specific census tract. At first, Marcus approached the problem with the logic of a professional. He assumed it was a bureaucratic glitch or a chance to shop for a better rate. He spent 3 days on the phone, moving from major carriers to smaller regional players. The responses were identical. Some agents were apologetic, others were brisk, but the conclusion was unwavering. "We are not writing new business in your area at this time." The silence on the other end of those phone calls is where the structural trap begins to close. To the bank that holds Marcus and Elena's mortgage, insurance is not optional. It is a fundamental requirement of the loan. Without a private policy, the bank will eventually implement what is known as force-placed insurance. This is a predatory, high-cost alternative designed to protect the bank's interest, not the homeowner's equity. Force-placed insurance often costs 3 to 4 times more than a standard policy, while providing significantly less coverage. For Marcus and Elena, this means an unexpected surge in their monthly escrow payment of nearly $1,500. In an era where the middle-class budget is already stretched thin by the cumulative weight of grocery inflation and rising utility costs, this isn't just an inconvenience, it is a structural rupture. When they ran the numbers on their kitchen table, the math was chilling. Their household income had remained stable, even seeing modest 3% annual raises. But the structural gap, the distance between their take-home pay and their fixed survival costs, was being eaten alive by a variable they couldn't control. The equity they thought they were building was being redirected to pay for a risk premium that provided zero tangible improvement to their lives. But the true horror of the uninsurable home is revealed not when you try to stay, but when you try to leave. Realizing the financial strain was becoming unsustainable, they decided to list the house for sale. Their realtor was blunt. In 2026, a house without a transferable insurance policy is almost impossible to sell to a traditional buyer. No sane lender will approve a mortgage for a property that cannot be insured at a reasonable rate. Suddenly, the market value of their home, which Zillow estimated at $600,000, became a fictional number. In a world where capital has withdrawn, the only buyers left are cash-only investors. These are often private equity groups or institutional landlords who self-insure. They don't need a bank's approval, and because they know the seller is desperate, they offer 70 cents on the dollar. Marcus and Elena found themselves in a state of financial paralysis. They are too wealthy to qualify for government assistance, yet too exposed to survive the withdrawal of the private market. They are trapped in a high-quality asset that is rapidly becoming a liability. Their house, which was supposed to be their greatest source of freedom, has become a cage built of brick and unpayable premiums. They represent a growing demographic of the stranded middle. These are people who did everything right, followed every rule of the traditional American script, only to find that the script has been rewritten in a language they don't speak. They are discovering that their ownership was always conditional. They owned the maintenance, they owned the taxes, and they owned the debt. But the safety of that ownership was a service they were merely renting. When Elena looks out at her neighborhood now, she no longer sees a collection of homes. She sees a grid of exposure. She notices the neighbor 3 doors down has a "for sale" sign that has been weathered by 6 months of sun. She hears the rumors of other letters arriving in other mailboxes. The sense of community is being replaced by a shared, silent anxiety as everyone waits to see whose coordinates will be deleted next. The psychological impact of this shift is profound. It erodes the long-term thinking that is necessary for a stable society. When you cannot guarantee the safety of your home for the next 5 years, you stop investing in it. You stop painting the shutters. You stop planting the garden. The American dream was always predicated on the idea of a fixed point in a turning world. Without insurance, that point becomes fluid and dangerous. The struggle of Marcus and Elena is not an isolated tragedy or a streak of bad luck. It is a localized symptom of a much larger, colder mechanism. To understand why their neighborhood was chosen for deletion, we have to look past the individual home and into the way the global financial architecture is being rewired for a century of retreat. To understand why the lights are going out for homeowners like Marcus and Elena, we have to look thousands of miles away from the suburbs, into the sterile boardrooms of Zurich, London, and Hamilton, Bermuda. This is the domain of the reinsurers, the titan corporations that act as the backstop for the entire global economy. Companies like Munich Re, Swiss Re, and Lloyd's of London do not care about the emotional value of a backyard or the quality of a local school district. To them, the American landscape is simply a vast, interconnected map of accumulated exposure. For decades, these global giants viewed the United States as a safe harbor for their capital. The risks were large, but statistically manageable. However, the model has fundamentally shifted. Reinsurers have realized that they are no longer just insuring against accidents or rare events. They are now insuring against a permanent change in the Earth's baseline. In response, they have begun to perform what is known as capital pruning. They are withdrawing their capacity from volatile markets and redirecting it toward more predictable, short-term financial instruments. This withdrawal creates a lethal domino effect throughout the American financial architecture. When a global reinsurer raises its rates or exits a state like California or Florida, the primary insurance companies, the names you see on TV commercials, lose their own safety net. Without affordable reinsurance, these local companies are legally required by state regulators to maintain massive cash reserves. When those reserves become too expensive to hold, the companies have no choice but to stop writing policies. The faucet of capital doesn't just drip, it is shut off at the main valve. This creates a direct collision with the American mortgage system. The vast majority of home loans in the United States are not held by your local bank. They are packaged and sold to government-sponsored enterprises like Fannie Mae and Freddie Mac. These entities have strict, non-negotiable mandates. Every single loan they purchase must be backed by a continuous private insurance policy. This is the invisible thread that holds the entire housing market together. If that thread is cut, the secondary mortgage market, the engine of American homeownership, simply stops. By 2026, we are seeing the emergence of ghost zones, entire counties where the housing market has effectively frozen. In these zones, a house cannot be bought with a traditional 30-year mortgage because no insurer will cover it, and therefore, no bank will lend on it. This creates a radical divergence in property values. Homes in insurable zones continue to appreciate, while homes in uninsurable zones plummet, regardless of their physical condition. It is a new form of digital redlining, enforced not by personal prejudice, but by the cold, unquestionable logic of a risk algorithm. But where private capital retreats, a more predatory form of capital often rushes in to fill the vacuum. We are witnessing the rise of institutional harvesting. Large private equity firms and hedge funds operate with a different set of rules than a family of four. They do not need a mortgage from Fannie Mae. They have billions in cash. They do not need a standard insurance policy from a local agent. They self-insure or use complex, captive insurance subsidiaries that operate outside of state regulations. They are waiting at the bottom of the cliff for the middle class to fall. When a neighborhood becomes uninsurable for an individual, it becomes a prime target for an institutional landlord. These firms buy up stranded assets at a massive discount, often for 60 or 70 cents on the dollar. They then turn these homes into permanent rental properties. This is a structural transformation of the American landscape. We are moving away from a nation of owners who have a vested interest in their communities toward a nation of permanent tenants who are merely revenue streams for a spreadsheet in Manhattan. The government's response to this crisis has been to create a series of state plans, or insurers of last resort. In theory, these plans are a safety net. In reality, they are a massive, unfunded liability that masks the true cost of risk. These state programs are often teetering on the edge of insolvency, relying on the hope that a truly massive disaster won't happen this year. By subsidizing insurance in high-risk areas, the government is inadvertently encouraging people to stay in the path of danger, while the private market is screaming at them to leave. This creates a managed retreat by default, rather than by design. The system is not telling you to move through a transparent policy or a public debate. It is telling you to move by making it financially impossible for you to stay. It is a slow-motion eviction of the middle class, carried out through premium increases and non-renewal notices. The tragedy is that the people being evicted are often the ones who have the least mobility. The elderly who have paid off their homes, and the young families who put every cent into their first down payment. The most unsettling part of this expansion is the realization that the system is not broken. To the global investor, the system is working perfectly. It is identifying a high-risk asset, and divestment is the rational response. The American dream of a fixed, permanent home was always built on the assumption that risk was a shared burden. But in the mid-2020s, that burden is being individualized. Capital has decided that it is no longer its job to protect your dream. It is only its job to protect itself. This structural abandonment does more than just drain bank accounts. It begins to alter the very chemistry of the human brain, creating a state of chronic, low-level survival stress that redefines what it means to be a citizen. When a home loses its status as an insurable asset, the impact is not confined to a bank ledger. It enters the nervous system of those living inside its walls. Humans are biologically wired to seek a secure base, a psychological term for a physical space that provides absolute safety. For the American middle class, the house was that base. When the financial system withdraws its protection, that base becomes a source of chronic, low-level survival stress. Neuroscientists have long studied the effects of unpredictable chronic mild stress on the human brain. Unlike a sudden disaster, which triggers a spike in adrenaline followed by a period of recovery, the insurance crisis creates a permanent state of hypervigilance. Homeowners find themselves checking weather apps with a new, dark intensity, not out of curiosity, but out of fear. Every thunderclap or heavy rain is no longer just weather. It is a potential financial execution for which there is no shield. This constant state of alert floods the body with cortisol, the primary stress hormone. Over years, sustained cortisol levels degrade the prefrontal cortex, the part of the brain responsible for long-term planning and complex decision-making. When you are worried about the structural viability of your future, your ability to focus on your career, your marriage, or your children's education begins to fray. The American dream becomes a cognitive burden that narrows your horizon to the next 30 days. This biological stress leads to a phenomenon known as maintenance paralysis. When a homeowner realizes their asset is stranded and uninsurable, a subtle but devastating psychological shift occurs. They stop caring for the property. Why invest $20,000 in a new roof or energy-efficient windows if the house cannot be protected or sold at full value? The nesting instinct, which has driven the American economy for decades, is replaced by a sense of temporary camping. As this paralysis spreads, the neighborhood begins to undergo a visible and social decay. It starts with small things: unmown lawns, peeling paint, or a fence that remains broken for months. But the real decay is the loss of social cohesion. In an insurable neighborhood, neighbors are partners in a shared investment. In an uninsurable zone, neighbors become liabilities. You start to resent the person next door for not clearing their brush or for having a clogged gutter. Fearing their negligence will trigger a localized disaster that you have to pay for out of pocket. The escalation moves from the individual to the collective psyche. We are seeing the rise of climate gentrification and algorithmic displacement, terms that describe the forced migration of the middle class. People don't leave because they want to. They leave because they are being priced out of safety. This creates a profound sense of betrayal. The victims are often those who played by every rule of the system, only to find that the system's definition of safety has moved to a higher income bracket. There is a specific kind of grief associated with this transition, a mourning for a future that was promised but never delivered. For the 35 to 60-year-old demographic, this is particularly acute. They are the squeezed generation, responsible for both aging parents and growing children. They expected their home equity to be the bridge to their children's college or their own comfortable retirement. As that equity evaporates into insurance premiums and devalued appraisals, the bridge collapses, leaving them stranded in the middle of their lives. The escalation eventually reaches a tipping point of resignation. When the cost of living in a specific place exceeds the psychological and financial reward, the community experiences a brain drain. The most mobile and educated residents flee first, leaving behind a more vulnerable, aging population. This reduces the local tax base, leading to the deterioration of schools and infrastructure, which in turn makes the area even less attractive to insurers. It is a self-reinforcing loop of abandonment that is difficult to reverse. By 2026, the unsettling reality is that the map of America is being redrawn into zones of the protected and the exposed. This isn't based on who is a good citizen or who works the hardest. It is based on who can afford the escalating cost of risk. The psychological toll of living in the exposed zone is the realization that you are on your own. The communal safety net of the 20th century has been replaced by an individualized Hunger Games, where the prize is simply the ability to keep your head above water. This shift in the American psyche is perhaps the most permanent damage of all. Once a population stops believing in the permanence of their home, the very foundation of civic investment begins to crumble. We are becoming a nation of people looking over our shoulders, waiting for the next letter in the mail, the next storm on the horizon, or the next algorithm to decide that our time is up. The mailbox at the end of the driveway was once a symbol of connection to the community, to the economy, and to a predictable future. Today, it has become a threshold where the cold reality of global capital meets the fragile hope of the individual. When the letter arrives, it doesn't just cancel a policy. It cancels a version of the future that we have taken for granted for 80 years. We are discovering that we never truly owned the land. We only owned a temporary license to exist there under the protection of a financial system that has now moved on. The withdrawal of capital from the American home is not a malfunction. It is a refinement. The system is simply correcting its past generosity, stripping away the subsidies of safety that allowed the middle class to thrive in the path of volatility. We are transitioning from a nation of stakeholders to a nation of risk-bearers, where the privilege of permanence is being restricted to those who can self-insure against an unpredictable world. The dream hasn't disappeared. It has merely been repriced beyond the reach of the math we were taught to trust. As the sun sets over 1,000 neighborhoods that are quietly being deleted from the ledger of the insurable, the lights stay on, and the lawns remain green. But the foundation has shifted. We are left with a question that the algorithms cannot answer. What is the value of a home if it can no longer be protected? Perhaps the most unsettling realization is not that the world has become more dangerous, but that we are finally being asked to face that danger alone.